gaps when you construct your trading strategy. And the reason being, unlike some of the more liquid markets like Forex, for instance, where gaps are pretty much non-existent, well, that's not the case with CPO. In CPO or FCPO, now I tend to switch this, CPO, FCPO, intermittently, they're both the same meaning. But what I'm trying to say is that, let's just look at an example here. Now, this is an example of a gap that occurs when market opens for a new trading day. As you can see here, it's a big gap. Now, I'm not saying that every time when there are gaps, it's going to be, of this magnitude, but it could happen. And when it happens, and if you're on the wrong side of a trade, well, it can really hurt. And if you've been trading CPO for a while, let me ask you, have you ever had a trade that gap against you that caused a much larger loss than you had expected? For instance, you enter a short position before the market closed, and when it opens on the next day, lo and behold, it just goes up and you kind of panic. Yeah, happens to me. If you're in this situation, did all of your trading plan go up in smoke because of the gap? You may have entered a short position at this pin bar or shooting star or whatever you want to call it, and you place a stop at the other side of the pin bar, and based on this stop, you have calculated, how much risk you're willing to take, how many contract size you're willing to buy based on this money management that you have here, and when it opens the next day, your stop gets automatically taken out here at not at a level here, but right up there, right where the market opens on the following day. Can you imagine how much loss that you have? Scary stuff. Do you find yourself paralyzed with fear when price gaps against you, not knowing what to do? Well, it happens. If your plan is like what we discussed before, where you have your stop loss at the other side of the pin bar, and it goes this way, all the way up, your trading plan basically goes up in smoke, and your loss may be much larger than what you had anticipated. So, the question is, what causes gaps in FCPO? The simple answer is, it is the reaction of the overnight movement of the US soybean oil futures market. So CPO, it closes at 6 every day during the trading days, 6 p.m. And when it closes, well, the US soybean oil will still run. And here's the thing, if the US soybean oil futures goes up, then this FCPO could potentially open higher, or it may even gap up when market opens. Now, the gap would happen if the overnight move of the soybean oil futures is huge. If it's small, then it may gap, it may not. If it's a huge move, then very likely you can expect to have a gap up when the CPO market opens on a new day. Similarly, if soybean oil futures goes down, then the CPO could potentially open lower, or same thing like what we discussed just now, it may even gap down when the market opens, depending on how far or how big of a move that the soybean oil futures made on the night before. Okay? So, obviously, there is some correlation between the soybean oil futures and FCPO. That's what we've seen just now. Because of this, it is no surprise that if you were to go to many of the CPO groups within the Facebook community, you see people posting soybean oil futures chart as as much as CPO charges in some instances, especially if there is a big move that the soya has made during the night. Many people will be excited to see, if there's a big move, what's going to happen to CPO, right? You can, they can expect a big win or a big loss, right? But I personally don't do that. In fact, I think it's pointless because, hey, we cannot make use of this info if we are already holding an overnight position. So, for instance, let's say you've hold a short position here on the CPO. After the market close, you decide to hold it overnight based on your trading plan. After the market closes, the soya goes up, in a big move, then you can expect the CPO to open up higher or even gap. Now, you may know this, right? But so what? What can you do? It's not like you can enter into your platform and get out at this level knowing that the gap up will take place. You can't. You are basically at the mercy of the market. So if you have sell stop orders somewhere here, then when the market opens, you're going to be taken out at a loss. If you don't have a stop loss, depending on your trading plan, of course, and market opens up like this, then it's, then you've got to make a decision whether you want to get out, stay with the market, you got to make some decisions there. But in any of the case, in any event, even if you can anticipate that a gap will occur on a CPO, there's nothing much you can do before the market opens, So what I'm saying is that either you ride it, if the gap takes place in your direction. So let's say if you go long and it goes gap up, then then you can enjoy the ride. You'll be in profitable position. Or if you go against it, then you may decide that it's better to jump off, lick your wounds, get ready for better in another day. It's just as simple as that. So what can you do? Knowing that gaps are very, very common in CPO. Okay, let's discuss this. So, if you have phobia with gaps, and a lot of people do, and you don't want to get caught on the wrong end of the stick, so to speak, you should just pretty much stick to intraday trading. If you go in during any time of the day, make sure that you exit before the day ends, because no one knows whether a gap is going to take place or not. Typically, gaps occur when market opens, but it could also take place during the second half of the session when the market opens after a midday break. But usually if there are gaps, it's going to be small because of, it's just 3 hours of market inaction, and normally you don't get much move of either the soya or more specifically the dalian market during this time. So usually the big moves are those that occur overnight. So if you're all nervous about gaps and you don't want to have anything to do with them, just stick to intraday trading, right? Now, if you are the type who wants to go for a multi-day kind of a strategy, then you have to expect to run into these gaps, whether they are in your favor or against your position. So the thing is that you need to have adequate funds in your account. Why? Because if you do not, depending on the size of the gap, if you have a position overnight and market opens the next day and it gaps against you, if your funds are too little, you may get margin call from your broker, because of inadequate funds. So my rule of thumb is that if you want to hold multi-day, you should at least have about 20,000 ringgit if you plan to trade one contract. And of course, you need to have more if you trade more contracts, more than one. That's just a rule of thumb. You may have other views, and it's always best to check with your brokers for advice regarding the margin requirements and all that, because because it changes from time to time. But have adequate funds if you intend to ride those gaps, right? And third, forget soya. Don't worry about it. Like I said before, like I've shown you before, even if it goes up, goes down, huge move, there's really not much you can do. And let's face it, when you start to develop your plan, your trading plan for CPO, maybe you use some indicator A or indicator B or some kind of strategy, and you do your back testing, chances are you will only be looking at CPO and CPO only. You're not going to look at soya. You're not going to back test soya and CPO together at the same time, right? I mean, most of us, we don't do that. So what I'm saying is that if you don't take soya futures chart when you were doing back testing on CPO, why do you have to worry when you're in actual trade? After all, soya was never part of your study when you were back testing your trading strategy on CPO, right? So who cares what soya? Forget it. You know what I mean? Make your life easier. Right? At least there's one less thing to think about. There may be some trading ideas or trading strategy that make use of soya and CPO correlation, but I mean, from my experience, the less variable that you have in your trading strategy, the easier it is to execute them. So anyway, that's all I have to say in this video.